Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Finally got above 3% this week, the highest since late May when we saw that 312 print go out in yields, but we sort of failed to hold it. We got there, we traded up there, we tried to stay above it, but ultimately on a week-over-week basis, we're unable to settle above that level. We backed off to about 295 after the employment data came out, and it just seems the market still holding that range-bound feel to it, 280 to 3%. We saw a modest trade above 3%, but unable to hold it. So right now we're still within that range, in that range of expectations. The market really didn't throw us off much, even though we are seeing higher lows being put in, or excuse me, lower lows being put in price, higher lows being put in yield. So the market is trending towards higher yields, but unable to get that key level settlement that we were looking for week over week, north of 3%. That being said, things are still looking pretty bearish in Treasury land. And if you look at market volatility, we did see a modest uptick. We did see things come off the lows. And if you take a look back at the chart and go back 5 or 10 years, we are still on the lows. And even though we did see a modest move higher, the market isn't showing any kind of reason for a spike, isn't showing any kind of reason for concern, no matter what we get out of China, or no matter what we get out of the Middle East, or what we get out of Europe, or wherever it might come from, data here in the U.S. The market just seems very unafraid of anything happening. And what we're seeing as far as moving yields higher is going to be more of a positioning trade, whether it comes from the Fed or whether it comes from supply and demand. But it isn't going to be coming from fear. It seems like a lot of the moves we've seen in treasuries have been fear and then the ebbing of fear, but that sort of is out the window right now. Market volatility still on the lows despite a modest uptick. And if we look ahead to next week, it's really kind of that post-employment hangover we get in the market, where we typically see a low and we wait for something to come out of that left field. We still have things going on with China, trade talks, their raising of their reserve requirement that sort of threw the dollar for a loop today. Likewise, we've got inflation data late next week, so it could be a quiet early part of the week as the market absorbs what we got this week as far as FOMC, the statement, and the jobs report, as well as the refunding. And likewise, we get to late next week, the inflation data will need to confirm what the Fed already has told us or hopes will continue, and that is a modest increase to inflation to allow them to continue to raise rates gradually as they want to raise rates in September and again in December of this year. So right now, 10-year note yields holding the range, volatility slightly higher, but it doesn't look like we're getting into anything hot next week. It should be a very tepid week, a range-bound week, at least until we get to Thursday and Friday. This is Todd Colvin coming to you from the floor of the CME Group.